Well, yes, Ridham Desai of Morgan Stanley has written a note of how India is better placed versus the globe to deal with this entire oil and commodity shock. Now, first up, they mentioned that a 25% rise in oil prices will expand the current account deficit by 75 basis points and increase the inflation by 100 basis points on an annualized basis. However, having said that, they believe India is much better placed versus how historically we have dealt with these oil prices. And the reasons are manifold. First up is the policy certainty. Now, this time around, the word coming in from the finance ministry as well as central bank has been rather unambiguous, and that tells them that the policy certainty will help the equity flows into the markets as well. Apart from that, they point out how oil consumption relative to the GDP is at all-time lows and is steadily declining, especially when compared to 2014. Separately, they also point out that monetary policy looks much better placed to handle the inflationary impact of an oil price rise, especially when compared to the 2014 levels that we had seen. Apart from that, they also talk about how India earlier used to rely a lot more on FII flows, but right now DII flows have been trying to match at least what FIIs have been doing, and to that extent the shock will be limited. Apart from that, they also talk about how the currency has been much better. So if you look at the INR movement, yes, it has definitely seen an impact of all that we have seen across the globe, but it has been much more insulated as compared to the big moves that we have seen in the currency across the world. So all of these reasons make Morgan Stanley believe that India is vis-a-vis better place as compared to history, but let's see where it heads, because as of now we have the equity markets which are definitely reacting to a whole host of geopolitical issues.